All right. The fourth thing that you may have never known, there isn't a specific formula for investing your money once you retire. And we bring this up because you have a lot of people when they come in and are getting close to retirement, or are retired, and they're under the impression, or they've heard or read something that shows that because they're retired or getting ready to retire, now they need to be in a certain percentage of bonds in their portfolio. And that's just,
It's kind of old school. A long time ago, they came out with this. I mean, like in the 70s or early 80s, they came out with this thing called modern portfolio theory. And the theory, and it was a theory, not a fact, was that as you're young, you have most of your money in stocks and very little or no money in bonds. And as you get older, you reduce the amount of stocks and increase the amount of bonds. Well, it hasn't proven itself to work, but they have lots of calculators and lots of tools that on the internet or that people use to try to do that. The idea being that bonds are safe. Well, bonds aren't safe. They're not safe when interest rates are going up, because as interest rates go up, bond market values go down. Do you think interest rates are going up or down? We believe that interest rates are going up and are going to keep going up. And we believe it's inevitable because of this inflation that we're facing that's going to continue to happen.
Another thing that's really important is that if you're going to invest in the stock market, you need to have a long-term time horizon if you want to have success. There just can be too much volatility in a short amount of time. Okay, so if you're going to invest in the stock market, you need to have, we tell people, usually at least a 10-year time horizon for when you're going to need all of that money. Well, if you're retiring, you probably have a 20-year retirement in front of you. You have a long-term time horizon, and most likely the safest thing to do is not to try to spend down your entire retirement all the way to zero by the time you die. That's not safe. The safest thing that you can do is try to invest your money so that it is at least keeping up with inflation and your withdrawals that you're taking during retirement. That's the safest way that you can ensure that you don't run out of money before you run out of time. And I have a quick chart here that shows different asset classes and how their average annual performance. And I just want us to look at here at the S&P 500 index and the Bloomberg bond index, okay? And what we're looking at is this column over here, the real return, which is the inflation adjusted return. The S&P 500's inflation adjusted return since 1970 is about 6.5%. The corporate bonds is a little bit less than 3%. So a lot of people are going to take out about 4% of their
4 or 5% for
investments. And how are you going to keep up with inflation, taking out 4% plus adding on inflation every year with this return? You're not going to be able to. So stocks are a necessary thing for retirees.
And so inflation, that's the greatest financial threat to Jesse and I and all Americans, everybody watching this webinar, and everybody in the world. Frankly, the greatest financial threat to everybody in the world right now is this high inflation that's inevitably going to get worse long before it gets better. And the best way to the best category of investments to be in during periods of high inflation is companies, because just think about the logic of it. If inflation is the rising cost of goods and services, what better logical hedge against inflation could there be than owning the companies that produce the goods and services whose prices are going up? And not only is it logical, but we can prove it to you. We're not going to do it right now, but we can show you the data. And if you're interested, you can come in and we can show you, we can talk to you about it on a Zoom call or whatever. But the stock market is the best asset class to be in during periods of rising interest rates and high inflation.